Why are Warren Buffett and Michael Burry both pulling away from the markets? Are they predicting a market crash, or simply preparing for the unexpected? When the smartest investors in the world go defensive, we should all pay attention. In today's video, we'll break down what Buffett and Burry are doing in 2025, why they've become so cautious, and what this could mean for the rest of us. Let's start with Warren Buffett. In Q1 25, his company, Berkshire Hathaway, hit an all-time record, over $347.7 billion in cash reserves. Yes, you heard that right. Almost $350 billion sitting in cash and short-term treasury bills. That's more than most countries have in their central banks. But it doesn't stop there. Buffett has now been a net seller of stocks for 10 straight quarters. Despite the tech rally and AI boom, he's been quietly trimming positions. He didn't buy into the hype. He's been selling into it. The only notable addition has been a modest increase in Occidental Petroleum. At the Berkshire Hathaway annual meeting in Omaha, Buffett was blunt. "We don't see anything that makes us want to deploy a lot of cash right now." He even warned that he doesn't see many bargains in the current market. In other words, high prices, high risks, and low expected returns. So what's his plan? Wait, stay liquid, be ready. Now let's switch to Michael Burry, the investor made famous by The Big Short for predicting the 2008 housing collapse. In 2023, he made headlines for buying put options on the S&P 500 and NASDAQ. And now, in 2025, Burry is doubling down on his bearish view. His fund, Scion Asset Management, is holding positions against major tech companies like Nvidia. He's also exited from several Chinese giants like Alibaba and Baidu. But perhaps most interesting, he's reduced his portfolio to just 7 stocks. That's extremely concentrated. His largest new bet? Estee Lauder. Yes, the cosmetics company. Why? Likely because it's undervalued in a tough retail environment. Burry has a history of going against the grain. When everyone's euphoric, he gets nervous. When markets feel invincible, he gets defensive. And right now, his positioning tells a very clear story. He expects turbulence. But what's fueling this caution from both investors? Well, the macro environment in 2025 is full of warning signs. In April, global markets were shaken after former President Trump, now leading in the primaries, announced new aggressive tariffs aimed at key trading partners. This reignited fears of a trade war, sent shockwaves through supply chains, and rattled investor confidence. Meanwhile, inflation is still stubborn. Interest rates remain elevated. Corporate profits are under pressure. Even strong tech companies are showing signs of slowing growth. The S&P 500 is near all-time highs. Buffett and Burry aren't buying the optimism. They're preparing for the downside. Let's talk about strategy. Why would someone like Warren Buffett sit on hundreds of billions in cash? Simple. Because cash gives you power when prices collapse. When markets drop, Buffett can swoop in and buy quality companies at discount prices. It's how he made legendary investments during the 2000 crisis and the COVID crash in 2020. And what about Burry? He's not just sitting in cash, he's actively betting against the market. That's a bold move. But for someone with his track record, it's also a signal. The risk-reward in 2025 is skewed. Upside may be limited, downside could be sharp. So, what can you learn from all this? First, don't ignore red flags just because the market is up. Second, liquidity is underrated. Cash isn't just waiting, it's a strategic position. Third, have a plan for volatility. Because if the smartest investors are preparing for it, you probably should too. To be clear, neither Buffett nor Burry is saying the market will crash tomorrow. They're not calling exact dates, but they're both positioning for uncertainty. And that speaks volumes. Buffett is watching, Burry is hedging. Both are being cautious. Are they wrong? Maybe. But if they're right, the investors who stayed nimble, who held cash, who avoided chasing hype, will have the advantage. So now the question is, are you prepared? Thanks for watching. If you enjoyed this breakdown and want more deep dives into what the smart money is doing, hit that subscribe button and turn on notifications. New videos every week to help you protect and grow your wealth in 2025 and beyond.